We're talking to the founder of the #1 Indian hedge fund. It's returned 90% to clients over the past 12 years and beats 90% of the 300 Asia-Pac hedge funds that we track on the Bloomberg system. Sachin Shah rejoins us from Mumbai. So Sachin, before we went off to break there, we were talking about your investment themes and your picks for the Indian market. In fact, 3 of the sectors that you like and the plays included consumption, tech, and even Mumbai property here. So first off, let's talk about the consumption space. I'm going to reel off some of the stocks that you like, which include Titan Industries. We have United Spirits, Mahindra Holiday, VIP Industries. Let me just ask you what the common themes are among these that make them a buy.
I think if you look at India's GDP, I think 2/3 of that is consumption. And that's the part which is growing very strongly. In terms of consumer confidence, we think we are back 80–85% of the peak that we've seen in 2008. So what we are looking for is a lot of these domestic branded businesses who have big distribution along with them, because we believe that as the lower sections of the society start consuming more because of government policies towards rural employment guarantee or taxation of helping more savings in their hands, I think a lot of these stocks which have reasonable business models, higher return on equities, etc., should continue to do well. And that's why we're buying the best Indian brands in terms of Titan, which is into watches and jewelry, United Spirits, which is the largest liquor company, VIP, which is the largest suitcase luggage company, or Mahindra Holidays, which has a unique model for domestic vacationing.
Yeah, and now, Sachin, when investors look at the Indian market, of course, a lot of the big IT names stand out. But in fact, in terms of technology, you prefer the smaller IT companies compared to the larger ones, such as Tata and Infosys. Maybe you can explain this rationale here.
Maybe 3 quarters back, when we were looking at the IT space, I think things were not as rosy as they were now. And there were certain companies like the ones we own, Infosys and Oracle. We believed that they were at reasonable valuations compared to market and larger tier companies. Both of them have parentage, which are big global firms. Infosys is owned 60% by HP, and Oracle is owned 80% by Oracle Corporation. So we thought these guys have parents which actually can provide them with getting into clients, and the strong momentum of these businesses would see through, and they were at significantly discounted valuations to where the market was or their peers were. So that's how we actually positioned ourselves. I think
Sachin, we're running out of time here, but let me just quickly get your stock picks on the property sector. You like Mumbai real estate better than anywhere else in the country. Why?
The only thing is we actually approach real estate through as a project. So basically we're based out of Mumbai. We know Mumbai is an island, cannot grow much. So we actually very positive on prices, and we can actually look at these companies and monitor those progresses. And the companies we are trying to play are not those land bank stories who buy land at huge valuations, but which are actually Indian corporates who had their factories in Mumbai and have not now relocated to the hinterlands, and the land bank on their balance sheets are at 50-year-old nominal cost. So we don't think there's much to lose. We think there are buoyancy in market prices, and we think the stocks are significantly undervalued compared to other pan-India real estate companies.
All right, that makes sense. Okay, Sachin, thank you so much for your time. Enjoy your holiday. That's Sachin Shah, the founder of Alchemy India Fund.